Welcome back to Palisade Radio. I'm your host, Tom Bodrovics, and joining me today is portfolio manager Jaime Carrasco. He's a portfolio manager at Canaccord. He set up his special opportunities portfolio in 2015, and one of your big themes that I really see coming up quite a bit is to hedge accordingly. You should almost make it a hashtag, Jaime.
Thank you.
So when we're looking at your special opportunities portfolio, and let's look at it through the lens of hedging accordingly. What are your asset allocations in there, and what have we seen as a performance in that portfolio since 2015?
Okay, first of all, the special opportunities portfolio was set up when I was at Scotia, dealing with a lot of family offices and very high net worth people down in Chile. I was a rep between Chile and Canada. It was set up because I realized that, when chatting with these people, with these institutions, they were all invested in the same way as everybody else. They had a European and a U.S. Money manager, and they were fully diversified into the stock market, but no exposure to precious metals. So in my opinion, asset allocation is key in that you should have 8%, according to Ibbotson, in precious metals at all times, in normal times, but these are not normal times. So the special opportunities portfolio is different in that it's a standalone solution into precious metals, is 90% in good quality producers, royalty companies, mid-tier gold and silver companies as well. So there is silver companies in there, royalty companies, and also blockchain, because I think blockchain is very important. But it's not full asset allocation. The other portfolio, my equity income portfolio, which is a portfolio that I have for people like my parents, older people, retired clients that require capital preservation income, that portfolio is more reflective of this conversation because that particular portfolio has 30% in precious metals. And so if you want to have a discussion on asset allocation, that's a portfolio I would want to focus on more. The precious metals portfolio, the special opportunities portfolio on its own, gives a really good outlook in terms of what has happened if somebody had precious metals within the volatility we've seen this year. In that portfolio, yes, did take a very big dip in March when the markets fell apart, but it also rebounded and today is at a value higher than it was in March. So it's completely regrown itself. It made the money back. So it's not really reflective of what's happened in an asset allocation model of the other portfolio, whereby, unlike anybody that's just been buying or trying to chase the Dow, and today we know, the market's down 1,000 points as we're speaking, that portfolio is more disciplined in that, anybody that followed my interviews on BNN in January, February, March, I was saying that I was raising cash expecting worse markets because of the signals that the repo market was already sending as of last October. And because of that portfolio right now sits in 30% in cash, which was the case prior to the decline we had in February, March, 40% in dividend-paying stocks, and 30% in precious metals. That portfolio has fully rebounded because of the precious metals content. Right, and that's the important thing. That 30% in precious metals is what allowed us to I'm trying to use the word reinflate, but it really isn't inflation because it's not an asset class that is overly owned by anybody. It's just money starting to finally drift into it. Into the sector, and I think that's going to continue because the precious metal sector on its own has done what it's always done for 4,000 years, which is gold is rising with rising systemic risk, and right along with that, the earnings of the companies are rising, which is why the sector is moving along, but is very anemic. If you really look at money flows into the sector, the money hasn't really started coming in. It's coming into the gold and silver, but not necessarily into the stocks just yet. But that will change because of the earnings, right? So the important thing back to asset allocation is the fact that from an asset allocation perspective, how does it work? So come March, we were sitting at 30% of the portfolio in precious metals. When the market fell apart, it went down to 25% of the portfolio. Right away, we rebalanced back to 30. What's the benefit of that? Is that by rebalancing back to 30%, we were able to buy more of the companies we like It's just the discipline of buying in times when things are really hitting the fan and selling when it goes beyond the 30%, so it becomes 35, 40%, then we trim it back. The benefit of asset allocation rebalancing is that it takes the emotion out of buying or selling, right? And that's why having a disciplined approach to it is so important. Now, here's another thing. The light is coming on. I'm hearing from investors that, hey, my broker called me and we bought some Barrick or some Gold Corp, right? So this is an actual example. I have a friend up here in Collingwood who was very proud that he had bought $25,000 worth of Gold Corp and $25,000 worth of Barrick for his portfolio. His advisor at a competing firm had done that for him. But then I asked him, I thought your account was $2 million, and he says, yes, it is. Well, $50,000 is not going to make much difference in terms of offering the protection that you need, right? Because it's just not enough. It's not enough to influence a portfolio. My advice is to get at least 30%. So in the case of that particular client, he has to get up to $600,000 worth in the portfolio. And that's why I set up the special opportunities portfolio. It's a standalone solution. And I said to him, look, you're going to have a couple of problems with your current advisor. First of all, he's going to have a very hard time rationalizing or to his compliance officers even a 10% position in this sector, which so far is still considered an aggressive sector. Let me back up. Even though gold itself, as per all the banking system, is now a tier 1 asset, the sector itself is considered speculative. So how is this advisor who doesn't really understand gold going to justify going to compliance and saying, look, I know that I should probably get it above 10%. That's what my client wants. He wants 30%. Well, so there's a disconnect here between compliance and money management. To offer a solution or a protection, a hedge to the volatility that we're seeing within the monetary system again into the portfolios, right? And that's why asset allocation is important, but as well to understand what we're doing and why you have to get yourself to a greater amount than the 8% that in the normal circumstances. As I keep saying, these are not normal circumstances. We are heading for a massive monetary storm. And, last March was just the first wave of what I think, if you really look at the cycle going forward, something that could last for another 2 years or so, as Charles Nenner, who was just interviewed again, who happens to be, in my opinion, one of the best cycle analysts, is saying that this thing should play out over the next 2 years.
When you're talking about asset allocation, how do you look at how to split that up within the portfolio? Are you looking at miners, producers? How do you structure that?
Okay. Within the special opportunities portfolio, which is more of a discipline approach, I've taken the same approach within both portfolios, but in that one, I'm able to increase the exposure and the diversification a little bit better because it's a concentrated portfolio versus the equity income portfolio. In the equity income portfolio, I have a good quality streamer, Franco-Nevada and Sandstorm. I have good quality producers, Agnico and First Majestic. I have a good quality between silver and gold. So that's within the specialized portfolio. Within the equity income portfolio, the one for the general client. Within the specialized portfolio, there's a little bit difference because it's a much more concentrated portfolio, I'm able to have good quality senior producers in gold and silver, mid-tier producers, which will have greater leverage in both gold and silver. I'm able to have royalty companies, both senior and mid-tier. And also now I've been able to buy one or two exploration companies, which I'm finally adding. And another thing, companies that have been dormant over the last 2 years, over the last 3 years, and now they're having to get restarted, right? And we have a number of those. I can't talk too much about them because we're in the process of acquiring and making some changes there, so I'm restricted from chatting about them. But they're companies that, we've gone through this massive down trough in the precious metal cycle where, we had silver prices down to down to $8 and gold down at 1,000. Well, there was a lot of projects that needed to be mothballed because there was no economic sense in keeping them going. Well, all of these over the last 2 years have been getting restarted because they're going to have to get restarted, and we had some great entry points. I'm right now evaluating a silver such company in Peru to invest in because, again, all of these projects are out there, and we just have to find them. And thank to Canaccord, who's also doing great legwork for us in the sector, looking at different projects that are getting restarted. Now, within the overall equity income portfolio, so what do we have there? We have a 30% allocation into, like I said, good quality gold and silver producers and royalty companies. Within the equity component of the portfolio, we have pipelines, utilities, REITs that pay cash flow. Companies really that no matter what happens throughout the global economy, like pipelines, utilities, things that no matter what happens are going to continue to generate cash flow to pay out the dividend. The problem is that we have a lot of volatility. So that's why that portfolio also has 30% in cash. Now that cash had been sitting in cash waiting and see what happens. I did not chase the market back up. What I'm looking at doing now is probably switching some of that cash over to physical gold and silver because I think I'm going to be sitting there for a while before I do anything. So I think it's better than holding cash because I think going forward, people should realize that cash is going to be part of the risk. Look at the U.S. dollar, at the USDX right now, which is flirting with 96. There's that milkshake theory that the U.S. dollar might start to rise, which is a good theory. There's also the view that the dollar might drop. From my opinion, when it comes to cash and currency, you have to look at politics. And from a political perspective, the more power that Trump gathers, the more that the dollar will be at risk because there is no MAGA with a high dollar. If you look at MAGA and Trump actually does start to gain quite a bit of political goodwill, which I think he will, and I think he is, it means that at some point he's going to want to deal with the U.S. dollar because you can't bring back manufacturing until you kill the cost of labor. Why is that important? Well, we're seeing jobs or manufacturing coming out of China, but they're not coming back to the U.S. They're going over to Japan. They're going over to Vietnam. They won't be coming back to the U.S. until you get rid of the U.S. dollar. So all of a sudden, the U.S. dollar becomes the weak link or the currency reserve, which is the one thing that I've been saying all along. Every time we've gone through these periods, we go through a reevaluation of the currency reserve. And I'm talking about the long-term cycle. The cycle that occurred in the 30s when the power shifts from the pound to the dollar. Now it's going from the dollar to something else. So it's the bigger picture has to be applied within the cycle and the money management. And that's why the asset allocation models are so important. But also we have to be conscious of the big picture, which is really the one that I'm looking at as how this storm is building and how do we position ourselves.
Absolutely, Jaime. Before we move on too much to the dollar and stuff, you sent me a couple charts this morning about contrasting gold, silver, the HUI, and the Dow. Maybe tell us a little bit about those and explain why it's so telling to really show how gold is performing in this environment.
Good question. So first of all, the first chart that I sent you was a comparison of and I've recently added silver to it. This is a chart I post every Friday after market closing on my LinkedIn because it really tracks the storm very well. Now, what it is a relative comparison. Had you invested $1 in the Dow, gold, and the HUI back to October 1, 2018. I think that is, even though I set up the portfolio in September of 2015 when gold was at 1,000, anticipating that was the bottom and gold was going to start moving. I started really tracking this on 2018 because that was the point at which the Fed was already starting to pull quantitative easing out of the system. My philosophy at the time was that as they start to pull money out of the liquidity out of the market, they're the only ones supporting the market, so we're going to have trouble. So that's when I started tracking it. And the Dow actually had a big reversal from October of 2018 right into January of 2019, forces the Fed to fully pull liquidity back in or stop raising rates. And now by the fall of 2019, we were into the massive repo problems that were rising, right? And by then, the Fed is full pulling quantitative easing back into the system, right? So everything has been reversed. So my theory that the Fed was going to lose control of the yield curve and lose control of what they were doing was dead on, and I was just following history. Every time we get into some central planning system, things don't work. So back to that chart. So what it does, it tracks gold, the HUI and the Dow back to October 1 of 2018. And if you look at the relative performance of that, well, the Dow is just back up at 2%, and gold is up 46%, and the companies are up 96%. So nobody's noticed this move that the companies are up actually quite nicely since that period. And what are they doing? They're just following the fact that gold is rising with rising systemic risk, and by default, the earnings of the companies are rising. Now, I also have to say that that move has been very stealth, because the only ones that have participated are those that are in the precious metals trade. Now, those are very anemic because of investor participation is below 0.5%, right? We were at 8 to 9% back at the last time gold was at much higher levels. So we really haven't seen that flow of money come in yet. So I think that once that light comes on, the precious metal sector is going to do even better. The second chart is back to February 20th of this year, which is when the market finally really took a dive. And when you do the comparison there, had you invested $1 in the Dow, you're still down 7%. In gold, you're up 5%, and in the precious metals, as of last night on these charts, you're up 11%. So again, having had a composition of precious metals within the portfolio, that increase of 11%, if you had 30% of a balanced portfolio within the precious metal sector, well, you would be doing much better than just trying to chase the Dow and chase the stocks, because really you're investing into hope.
Excellent, Jaime. When we think about how all this money printing is going to affect the general equity markets, we were speaking earlier about how the Fed is losing power to the Treasury, and the Fed and central bank aren't really working together. Can you explain a little bit more about how that's going to work?
Okay. Well, first of all, I think it's very important to understand the change that occur sometimes in April, I think it was, when for all intents and purposes, Trump took the power away from the Fed and moved it over to the Treasury. That's very important because if you look at how money is entering the economy today versus 2008, yes, the banking system is still getting the liquidity it needs to stay alive because we really can't sink the ship yet. But unlike 2008, money is entering the real economy. It's getting out to people, which means that we are starting deflationary wave, but at some point, all of this money velocity is going to start to creep in back into the system, which means that it's a very important difference in that the Fed is not in control of the money printing. All the Fed is doing now is actually buying junk debt, Hertz, Boeing, all of these companies, which kind of is important to me because if you're gonna reset the system, the monetary system, you need to have a couple of things in place. First of all, if you're going to reset the system, in my opinion, you're going to do it the same way we've done it before, which is back to some kind of hard money system. In a sound money system, well, you don't need the Fed because you're not going to be printing money anymore. You need the Treasury. So back to where it was in 2013. Check number one. Check number two is the fact that from a geopolitical perspective, we're starting to see more and more pressure between China and the U.S. That's important because that pressure or economic stress between the two, these are the two new economic leaders going forward. Well, the fact that they're not working in conjunction is very important because now it means that they're really breaking up the puzzle or deciding, well, who owns what within the geopolitical structure that's going to come out. Now, everybody's betting that Trump is not going to get in 2020, so they're making that assumption. I'm assuming again that Trump is going to win, which means, well, how do I or the system resets within a Trump reality? Well, again, when it comes to the U.S., I think what Trump wants is to unwind the current globalist system, which means that he wants to unwind the debt system, but in order to bring back manufacturing to the U.S., he would have to kill the dollar. Now, that's very important because it means that he's going against Wall Street for the benefit of Main Street. The change between the Treasury and the Fed is signaling exactly the same thing. It's funny because Judy Shelton, still her nomination for the Fed, has gone quiet, but is still in process. Now, that's very important because she is a sound money advocate. Now, if she comes into the Fed in the current structure, it's great because it means that you'll have somebody overseeing whatever happens within the Fed within a sound money system, right? Also, this whole political trend that nobody's really paying too much attention, because I think a lot of people are still listening to CNN, is the whole Russiagate thing. I think that's very important because it's really implicating the Democratic Party as though having actually done some bad things within the Trump campaign that could be considered treasonous. Now, I'm not going to speculate any further, but it's definitely a page 16 story that could quickly move into the forefront and raise Trump's power some more. Now, that has economic consequences going forward for the puzzle that I see shaping up. So I do think that the storm is gathering and a lot of changes is ahead of us. And a lot of that is going to be within the U.S. dollar. Now, there's also this milkshake theory that I think Nick Santiago has been talking about, which makes a lot of sense. Yes, the world needs dollars. We have a need for liquidity within the global structure. Now, that's important, but it's also, I think, one of the bets that should not be negated is the fact that the U.S. still controls 8,900 tons of gold. I do think that gold is there. The gold that has been taken by China is everybody else's gold. If that is the case, well, Trump still has a big trump card, which is the 8,900 tons of reserves within the now 35,000 circulating between all central banks. So it means that he still controls the real value of money. So it gives him quite a bit of flexibility within restructuring the dollar. So I would not be betting exactly with a rising dollar, because I think Trump couldn't care less what the needs of the rest of the world are. I think what's more important to him, if he gains enough capital political goodwill within the U.S., I think what's more important to him is how can he play to his populist leanings within the U.S.
So as you're mentioning, the amount of physical gold that the U.S. has, one of the reasons I wanted to have you back on was you've been posting a lot about accumulation by the central banks. And something I'm really trying to understand and wrap my head around is how that's going to bode well or poorly for these countries going forward, like Russia, China, and the U.S. So can you explain a little bit more about what that could mean for those countries and those central banks going forward in this environment?
Well, I think in order to fully understand that, the best example is to go back to the end of the Second World War and the restructuring of Bretton Woods, right? Once Bretton Woods gets reset, so that was the new monetary system after the Second World War, following the setup of the good as gold dollar in 1933. We're jumping to 1947, 48 when Bretton Woods gets set up. And the way it was set up, it was at that point, well, the U.S., there was 28,000 tons circulating among the whole global economy. That was the actual money supplied measured by gold. The U.S. at that point had 22,000 tons of that. Within that structure, the U.S. dollar carried 90% of the purchasing power of the new currency. Okay, so use the same math. Today we have 36,000 tons circulating between all central banks. The U.S. still has 9,000 of those for intents and purposes. Russia has 2,000. I think Russia really is at the sidelines. What they have is a lot of food, a lot of energy, a small population. But I think they're gonna just play within the two players. The two players are really China and the U.S. China has 1,800 tons within it. Now we know that China has transferred 20,000 tons since 2008 from the West, so they're sitting on a lot more. But that gold is sitting within the populace. So if anybody's going to confiscate gold, in my opinion, it would be the Chinese, do a Roosevelt. Which means that if there is 20,000 tons sitting within China, they're sitting on the bulk of global reserves as measured by gold. But it still gives the U.S. Quite a bit of trump because they have 9,000 tons of those 20,000, which means that in the resetting of the purchasing power of wherever new currency is reset to deal with the debts, the U.S. will still carry about a third of the purchasing power. And that's what's important, is the purchasing power of whenever new currency comes out. in that environment, Canada loses because Canada has no gold. We sold it all, and our central bank refuses to see gold as money. You know, it's funny. Bernier, the Prime Minister of Quebec, came out this week saying about a gold standard and the need for gold. Well, you know, it's funny because we can't vote for him being in Ontario, but he makes a lot of sense. Well, my attitude has always been to recommend my Canadian clients to set up our own gold standard. Gold in Canadian dollars is tracking $2,400, and it's really tracking the loss of purchasing power within the Canadian dollar. Well, in a new monetary system, because in order to unwind all of these debts, well, the Canadian dollar is not going to be worth much, or its purchasing power won't be much, right? So I'd rather have my own gold standard to make sure that my savings are going to benefit from that. And this is the problem, that in that kind of reset, he who holds the gold controls the rules, meaning that they control the purchasing power of whatever commodities and resources are available in the world, right? And that's what always happens, that governments don't default on their debts. They devalue their currencies because the debts are valued in that currency, which means that the new currency will carry the purchasing power of the new structure as per your control of power, i.e. gold.
Right. So another piece of the puzzle that I've been trying to understand is the Comex, and they have a record 151 tons of gold that has been submitted for intent for delivery. Are they going to be able to deliver this, and what happens if they can't actually deliver that physical?
Well, when it comes to the Comex and the LBMA, I've always said that it's a game of musical chairs, where the music will never stop because central banks can continue to print money and they can continue to print tickets for people jumping in and dancing around the chairs. The difference is that the chairs have been taken out, right? The chairs are leaving, and sooner or later they're going to run out. So it's not that the music is going to end, that the chairs are going to end. And I think we're very close to that. The fact that right now, next week on the 19th, I think it's when the next contracts mature. Well, look at what happened in March. March was the last contract delivery date. And even though the LBMA and the Comex came out and they had this big marketing campaign saying nothing's wrong, and I said, well, if they're saying this, something is wrong. Well, something was wrong. They had to fly in about 100 tons, I think it was, from Switzerland in order to satisfy those deliveries. Well, are they going to be able to get another 100 tons again from Switzerland? Highly, I don't think so, because refineries are just getting going again. The industry's just starting to smelt again. So at some point, we're going to have a force majeure. Force majeure means that they're going to fess up to the fact we don't have this gold. What they're going to do is exactly what I think it was HBC did it 2 months ago, where everybody, all of their clients that had a paper contract for physical gold sitting at about $1,350 at the time, they got a letter and they said, look, we don't have that physical, even though we said we had it. Again, this is what we call counterparty risk, trusting a bank to actually stick to its promises. I'll end it there. Well, what they sent a letter to all of their clients and they said, look, we don't have the physical we told you we sold you. What we're going to do is as of Friday, you're going to get $1,350 because that's the value of the gold. Here you go. That's force majeure. You're getting the paper, the fiat price. Well, then you got to go out. If you want that gold, you got to go out and source it. Well, you couldn't get it for under $1,400 to $1,500. Now we're talking about $1,800. So that spread to the actual physical is starting to rise. What you're going to get stuck with is paper. Now, this is an important point because it brings us right into the discussion of ETFs, the GLD, the SLV, all of these, the Bullion Bank and the World Gold Council keep coming up that, the ETF took in so much gold. My question is how much of that gold is actual physical versus paper contracts being issued by the banking system? Well, if it's paper contracts being issued by the banking system, I don't want it. What I want is actual physical sitting in a vault, right? And that's where we're getting into this disconnection. It starts at the Comex, but if the Comex can't deliver, well, nor can all of these counterparty promises to deliver that I know can be delivered because it just isn't there. So that's what this is about. It's that facade between what's being promised and what can actually be delivered. And by the way, if we look at that, look at the CIBC in its earnings report. They reported losses because why is CIBC selling paper certificates, right? They fessed up that they had losses because they had shorted gold. So in essence, they were selling paper contracts. So I don't know, if I'm a CIBC client sitting with some paper certificates from CIBC, I would really have a question mark in my head whether those are going to be given back to me or not. And that's why I think we have to be very careful in terms of a full understanding of physical versus paper.
Excellent, Jaime. So to wrap all that up, you're really assessing counterparty risk and seems like you're really concentrating on having some physical actually in your vault or in your possession of some sort, correct? And
in the ground. The best vault, and I have to reemphasize this is why I like my companies. This is why I have those senior producers and those good quality producers, mid-tiers, because they have reserves on the ground. Go back to when gold was sitting at $1,900 back in 2011. Those reserves on the ground were trading at about $60 to $70 an ounce. Right now they're at zero. Very little value in them. Well, what do you think is going to happen when we have what's the leverage on the paper contracts at the Comex? It's greater than 70 to 1, I would imagine. I haven't looked lately, but I know that at the height it was something like 200 to 1, according to Ted Butler. I haven't looked into it, so I'm not going to say the number, but it's huge, right? So what's going to happen when the light comes on, we're out of physical? Oh, wait a minute. Well, Agnico Eagle is sitting on, 20 million ounces on the ground, right, in good geopolitical areas. Well, those reserves are going to have a lot of value. Right. And again, history is going to repeat itself. If you go back to the 30s, Alaska, Juneau, Homestake Mining, they had a lot of value, not only because they were still producing at $5 when gold is sitting at 35, so the dividends were quite rich, but they also had all those reserves that would have been mined at some point. I think history is not going to be any different. Right. When the light comes on, then people are really going to want these companies that I've been buying over the last 3 to 4 years for my clients, and we're going to be sitting on gold mines. And the pun was fully intended. Yeah.
Excellent.
So yes, reserves are going to be very important when the light comes on. And within that, by the way, I think the blockchain also comes into fore because it offers an electronic solution not to have a banking system anymore.
Is there anything that has any kind of confidence behind it, like the banking system, though? It seems that trust is going to take a long time to build in that particular sector for the mainstream adoption of a technology like that, no?
Well, for that, I would take a completely different tack, and I would say this. First of all, at what point did each person in the Titanic realize that the trip was going to be a little bit different than they thought? Okay? Second point is all those that made it onto the lifeboats had a lot of time to ponder what the new world was going to be like. Right, and I think that's where we're at. We're just starting the crisis in that the realization of how bad things are hasn't really entered the mainstream, right? I've done the numbers because I've come at it from the debt side, from the history side, and I'm very comfortable with my stance and my investment philosophy and how I'm advising clients. I have to say that clients are actually realizing that, hey, we're on the right track, so they're very comfortable now, especially after the decline we had in March. Now, with the bounce we've had since then, they're realizing, okay, we're on the right side. Now, within that, I think it's early on to try to reassess how do we rebuild the system. I think if history is repeating, the historical parallels of a debt unwinding as we're going through have always played out the same way. They played out the same way when the Soviet republics fell apart. They played out the same way in Brazil, in Chile, in Argentina. They played out the same way in the Weimar Republic. Over the next 2 years, the avalanche has already started. So this unwinding, and actually it goes right along with the parallels that Charles Nenner is saying, that within the next 2 years, this thing is going to fully unravel because it's picking up speed. Within 2 years, the avalanche will stop, and then we're going to know what kind of economic damage we have as we start rebuilding things, right? At that point, we can assess how we're going to do it. You know, what are going to be the tools that we're going to be using for that. It's funny, I was having a chat with my eldest son. It's been great, COVID-19, spending time here in Collingwood because I've had time to chat with my kids. You know, he's 23, and we were talking about this, but from a historical perspective. And what I said to him, look, the last time we messed around with a fiat system, it was the French, right? The French with the John Law period in the late 1770s, okay? Well, as France is falling apart, the currency reserve has been completely decimated because they started borrowing and printing money, which, by the way, the second thing the French did after cutting the king's head off was go and burn the printing presses in Paris, okay? Well, on the other side of the channel, there's these two guys, Isaac Newton and John Locke, figuring out, okay, what are we going to do? We're going to rebuild the monetary system based on gold. So they figure out £7 per ounce, and we're going to structure a new currency called the gold standard. They set up the gold standard. Well, the gold standard was set up because of decimation of that ship sinking at that point, and how do we restart the system properly? Well, this time we're going to go through the same process. Hard money is going to be within that. But all of a sudden we have an electronic solution to the problem, and that's the blockchain. That's why I'm so excited about blockchain, because it is part of a decentralized system, which is what we really need to move forward, right? So what I was saying to my son was, think more in terms of the view that Isaac Newton and John Locke took at that period. As everything's coming unwound, well, how do we set up the right structures going forward? This is why history is so beautiful. This is why I fully believe that the further back we see history, the better we can judge the future, right? Because it gives the exact same parallels. Back then, all we had was the printing presses, but the money system, which has been constant forever, well, these guys knew that, and that's why Isaac Newton was able to set the structure. And by the way, the Industrial Revolution, which lasted for a whole century, was built behind a sound money system. And that's why I'm so optimistic, right? I'm pessimistic in that I see that we're going to go through some massive economic turmoil, but I'm very optimistic in that if you're positioned properly, you will survive and have the resources to participate in what I think is going to be a beautiful new structure, because we're going to be building from something that needed to be unwound anyways. It carried on for too long. So again, I'm trying to be bottle half full and be an optimist instead of concentrating too much on whatever negativity comes next, but I don't think it's going to be pretty. Going forward, the one thing that I've been saying to clients is this: if history is repeating and we're allowed to let the Fed print money until the cows come home, the Dow could go to 50,000. Or if we're mature enough to let, which I think is going to be the case because Trump does want to get elected, and we know what the marketing line from his campaign is. Oh, the stock market's up great, unemployment's great. And by the way, he's using the same statistical adjustments that the past, so Obama was using and Bush was using to justify that everything was great, right? So to me, nothing's changed. The only difference is it's another guy driving the bus. Now, within that, what's important is that at the end of this, the Dow could be at 50,000, or it could be at 10,000 or 5,000. Gold is going to meet it there. Whether we go into hyperinflation and we end up at 50,000, gold will be at 50,000. Whether we crash to 5, as Charles Nenner thinks, gold will be there too. So no matter what, gold wins. And that's why in the cleansing, gold is money, and he who owns the gold sets the rules. And so I'm very, very conscious that I'm on the right side of the trade.
Excellent, Jaime. Well, that's some great optimistic forecasting for the gold market. Any other thoughts as we wrap up?
Just expect greater and greater volatility over the next 2 years and hedge accordingly. Actually, I should put a hashtag on that. I think hedging accordingly is going to be very, very important. I'm going to continue to advise clients to hold 30% at the very least within their investable assets in precious metals. Now, again, within the rules that I've been using is good quality companies with low cost of production in geopolitically safe areas and high reserves on the ground for the basis of those portfolios. Over the last 2 years, I've been looking at all of the companies that have been dormant that offer great entry points, and now I'm finally adding some of the exploration companies. I don't want to talk company specific. I want to stick to the bigger picture. By the way, I manage The portfolios I manage are not mutual funds. They are segregated portfolios. So if clients come in, we actually buy the companies for them in the same percentage basis as are in the model portfolio. So everybody gets the same companies. And those are managed with a management fee, and that's it. Okay, so there's no commissions. We just manage portfolios. One is the fully diversified portfolio, and then there's the standalone solution, the special opportunities portfolio, which is for the client that's quite happy with his relationship elsewhere, but realizes, hey, okay, I got to get myself to 30%. Here's a standalone solution for that.
Share with us where we can find more of your posts. I really think you need to start your hashtag of hedge accordingly, because it seems to be has a lot to do with a lot of the articles that you post.
Well, thank you. On my LinkedIn and everything gets shot over to Twitter, and I really like Twitter because there you're able to better segregate between the people that I really like following. Peter Bookbar. There's so many bright guys. What is very positive is that more and more people are getting it. More and more investors are coming on board. More and more are questioning. The fact that people are questioning, there is that sense of awareness. Awareness is the first thing, right? That there is a problem, which is actually what I'm seeing. Just on a side note, so I don't know if you came across the interview with John Hathaway, who's now is within the Sprott family of funds. Well, he was saying that calls are coming in, but it's for physical, not yet for the companies themselves. That will come, and I think it's just anemic right now, but just wait until the flood really starts to come in, because what is happening? So since March, institutions have finally raised cash. Retail has been chasing the market up, and I think now they're going to get a little bit burnt on that. But institutional money, as they're sitting on cash, they realize, okay, maybe I should have some physical. So the physical's in. Now they're going through the same process I went 4 or 5 years ago. Okay, aside from the physical, why the companies? And so that awareness starting to occur. And the fact that we're getting more and more questions is so important because, finally people are questioning things. And that is important, awareness.
Excellent, Jaime. Thanks very much for your time today.
Well, thanks for having me again. It's always great, and look forward to the next time.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.
Think you understand the junior mining sector, and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip-your-face-off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?